Just like the broader market as a whole, INTC stock is down nearly 30% year to date. Now, trading this price puts the company in an interesting position for a couple of different reasons. We do have to keep in mind that we may be in the midst of an economic downturn. So what does that mean? Well, this company is the world's largest producer of PC and data center CPUs. Because of this, it has remained resilient throughout previous economic downturns. And not only so, it's generated plenty of cash to cover its share buybacks and dividends. Now, we do have to keep in mind trading this price is also giving it a dividend yield of nearly 4%. It's sitting at about 3.91%. So because of this, we're going to be jumping into my stock valuation spreadsheet to see if this is a stock we should be buying or selling. And on this spreadsheet, we have 4 different valuation models to calculate intrinsic value. We have Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model. And all of this will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and we're going to plug in INTC, the stock ticker, and hit enter. And we can see we have all of this data coming in, and we're currently looking at a 365-day change. Let's go ahead and zoom in a little bit and do 250 days. And we can see we have seen a pretty large decline, currently sitting at about its 52-week low. The dividend is currently $1.46 a share, dividend yield at 3.91%, and their payout ratio really low at 23.2%, which I really like. It's going to allow the business to continue to grow and to increase the amount it pays in dividends. Now, all of the 20, 50, and 200 moving day averages are down by double digits. We can see the past year down by 34%, past 2 years down by 38%. Now, analysts do have a target price of about $51 to $52 per share on this company, and the institutional ownership is sitting at about 64%. But let's go ahead and jump over to Graham's valuation. And Graham's valuation is a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors. You can see the formula he laid out for us right here in order to calculate intrinsic value. So what we do is we take the earnings per share of the company and we multiply it by 7, which is the price to earnings of a company with no growth. We then apply our growth rate projection. So while analysts are projecting a slow growth rate for this company, we can see because of the strong earnings per share, our intrinsic value is still going to come out pretty positive. We're then going to multiply this by 4.4, which is the average yield of AAA corporate bonds. And then we're going to divide this all by Y, which is the current yield of AAA corporate bonds. And the higher this number is, the lower the intrinsic value is going to be. So because of the market's downturn, this current yield of AAA corporate bonds has continued to decline. At the time of this video, it's sitting at 4.13. But after we plug all of this in, the intrinsic value is sitting at $65 per share. It's mainly because of the pretty strong earnings per share we see from this company. Now, we do have to keep in mind, just about a year ago, this current yield of AAA corporate bonds was sitting at about 2.5. So if we were to apply a 2.5 current yield on AAA corporate bonds, we can see this intrinsic value would go way, way higher. But let's go ahead and switch this back to 4.16 and hit enter. And we can see Graham's valuation, intrinsic value of $65 per share. But let's go ahead and jump over to our discounted cash flow model. And in order to perform our discounted cash flow model, we need to project a growth rate for the future free cash flows for this company. So in order to do so, I've plugged in the historical free cash flows right here, as we can see, which allows me to see the growth rate over the past few years. We can see the past few years have had an average growth rate of about 6.63%, which is on line with analyst projections. I'm applying a growth rate of about 7% for the future free cash flows of this company. I then calculated the terminal value using that same growth rate, which is the sum of all the free cash flows past the year 2030. I then took the present value of these future free cash flows and added them together here. After adding the company's cash and cash equivalents and subtracting out their total debt, we calculated our equity value. After we had this number here, we divided by the number of shares outstanding, and we came to a discounted cash flow price per share of $50.54, which, if we jump back over to our stock screener, we can see that actually is pretty close to our analyst target price for this company. But let's go ahead and jump over to our multiples valuation model now. The idea behind our multiples valuation is using a price to earnings multiple. We should be able to see how the intrinsic value of INTC is relative to companies that are similar in structure to them. So what we're doing is we're taking companies that, like I said, are similar to INTC, like Taiwan Semiconductor and Micron Technology. We're taking their stock price and dividing it by their earnings per share to find their price to earnings multiple. We then take the average price to earnings multiple for these companies and multiply it by INTC's earnings per share. And this gives us an intrinsic value using the multiples valuation model of $78 per share. So we have to keep in mind these are competitors of the same company, and most of them are trading at a higher price to earnings multiple for INTC. So if the market were to value INTC at the same price to earnings multiples of these other companies, we would see a higher intrinsic value. Let's look at our last valuation model, which is our dividend discount model. And as a value dividend investor, I think this model can carry a lot of weight. The idea behind this model is we should be able to value a company based on how much they pay out in dividends and how much that dividend payout is increasing over time. So what I've done is I plugged in the quarterly dividend payouts over the past few years so I can see how much they've been paying out yearly. And this is going to allow me to see the growth rate over the past 4 to 5 years. And we can see they're pretty consistently right around 5% with their dividend growth. So I'm applying a growth rate of 5% moving forward. After applying a discount rate of 8.5%, we can see our dividend discount model gives us a price per share of $43.80. Now, anytime you do have a decent growth rate, we do want to jump back over to our stock screener and we want to move up and check that payout ratio. And just like I said earlier, payout ratio is at 23%. So that's a great payout ratio. So nothing to worry about. This is a very safe dividend. But dividend discount model, intrinsic value of $43.80. But let's go ahead and jump over to our output tab. And here on our output tab, we have all 4 of our valuations: grams at 65, multiples at 78, discounted cash flow at 50.54, and dividend discount model at 43.8. When we average all 4 of these together, we can see we come to an intrinsic value of $59.38 for this company. And the current price is currently sitting at $37. Now, we are value dividend investors, so we do always want to apply a margin of safety when trying to make value dividend investments. So let's go ahead and apply our 30% margin of safety. That's pretty conservative. We'll hit enter. We can see based off of this, we have an acceptable buy price of $41.57. So our stock valuation spreadsheet is telling us this is a stock we should be buying. Now, there are still some risk involved with this company. Obviously, we may be in the midst of an economic downturn. So if this company continues to decline, we really don't know when it will start to reflect its intrinsic value. Something else that we do need to take note of is they have been losing some of their market share over the past few years. We can see Intel, one of their competitors, AMD, has continued to increase their market share, which is making Intel's decline. As of 2017, Intel had about 80% of the market share. They're currently sitting at about 65%. So that is 2 things that I would say is one of the risks with INTC is their declining market share, along with the potential continued economic downturn. Despite this, I do think this could be a value dividend investment. Even at its current price, if it continues to decline, you will get a great dividend yield and dividend growth. As for me, I do already own some shares of INTC in my personal portfolio. It does provide pretty solid dividends with dividend growth. I do have them on my watch list, and I will consider buying more in the future if it continues to decline. But go ahead and let me know in the comments below if this is a company you own or you plan on buying in the future. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.